Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. I've once again left highlighted in bright red on my daily chart the neckline of the August to November 2021 complex triple top, currently at 24.33. As it was, and still is, part of what I suspected 11 weeks ago might be a new pattern. It is the November 2023 to date descending scallop pattern. The bright red neckline plus the congestion between 2390 to 2408, containing July 2012 high at 2400 and the 50% Fibonacci line of the combined March to November and November to December 2023 move, all these together are at the moment providing overhead resistances. Now, going back to the descending scallop pattern, this backward letter J pattern has finished its run upwards, as the target in the upside for the run upwards in the 2405 area, and that was achieved 5 weeks ago, even exceeded a little indeed. This is the question I posed back 3 weeks ago, and I quote, "The question now is what's next?" Well, typically for such a descending scallop pattern there are two pathways. You could expect a hesitation around this 2405 area for a short while before either a drop back down to the December 2023 low zone down in the low 20 evens, or after a hesitation, a fresh move higher that will punch up through the November 2023 highs in the 2814 area. As I said earlier, we are in the hesitation part of the pattern now, and this could be a topping pattern this past weeks or so, or even if we take a little wider, a possible bull flag. The only thing I would caution you on is to watch out for false breaks in either direction. And that's the end of the quote. Since then, we have seen a steady decline, almost a bear channel that has, for the most part, run along the underside of the purple highlighted upper time, currently at 23.24 of the early November 2023 to mid-January 2024 bearish shift pitchfork, and captured on the downside by the declining short-medium moving average, currently 22.53. Ideally, you would expect by now to ascertain if this was a false break or lower or not. However, it is such an orderly decline that it has elements of the previously mentioned descending scallop pattern plus elements of a possible bull flag. Contrary patterns for sure. I put this down to the lack of any significant supports below, bar the congestion at 2235, all the way down to the start of some significant congestion at the November 2017 high at 2148. So in theory, it could drop all the way down there, or even somewhat lower, and still be bullish. This is not an ideal situation. However, on balance, I'll stick with the upper time of the bearish shift pitchfork, and obviously to the declining short-medium moving average. I'll stick to those until something better turns up. Ice Europe white sugar in London. This is the current situation for the nearby supports and resistances. As you can tell by the number of lines across my daily chart, there's a lot of it. Overhead, we now have quite a way above. We have the declining long moving average, currently 687.20, and a declining medium moving average, currently 679.10. Then there's congestion around the recent November to December 2023 50% Fibonacci line in the 679 area. And then the March 2012 high at 674.90. The July 2012 high at 663.70. And then we hit the 650 to 652.20 congestion zone, containing the 50% Fibonacci line of the January to September 2023 move at 652.20. There's also a further congestion below at the 635.30 to 638.20 zone, containing now the declining short-medium moving average, currently at 635.40, followed by stratified supports between 625.30 down to 602.70. Just below this congestion is the October 2022 to date breached but not broken purple colored uptrend, currently at 600 even, which is at the moment in a free area between the overhead 625.30 to 602.70 congestion and further congestion below between 590 even to 592.80. All this sums up where the nearby supports and resistances are. Okay, so what's next? Well, I said the following 3 weeks ago, and it's still valid, and I quote, "In the process of falling, hesitating, and then rising, the market created, just like in New York Sugar, a November 2023 to date descending scallop pattern. This hesitation is around the original preliminary target for this pattern in the 670.90 area. The question here is the same for London and New York Sugar. What's next? Well, typically for such a descending scallop pattern, there are two pathways. You could expect a hesitation around this 670.90 area for a short while before either a drop back down to the December low zone, down in the 585 even zone, or you could see after hesitation a fresh move higher that will punch up through the November 2023 high in the 772.90 area. As I said last week, so that's 4 weeks ago, as I said last week, and I quote, "We're in the hesitation part of the pattern now, so I'd only caution you to watch out for one thing, false breaks in either direction." And that's the end of that little quote in there. All I would add to this now is we seem to be getting ready to exit the hesitation phase. And that's the end of the full quote. Since then, prices have a changeover gap lower and are much more advanced on the downside than New York Sugar, such that we are realistically looking at a potential test down to the December 2023 lows down in the 585 even zone. This prompted me to draw in bright red an early November 2023 to late January 2024 bearish shift pitchfork. And though prices have not slid down along the underside of the upper tine, which is currently up 649.5 as they did in New York, the bearish shift pitchfork does still show the bearish angle of attack of the market, with prices in between the upper tine above and the middle tine below. The middle tine below is currently at 581.70. Sugar white premium spread. It must be close to, if not over, a year here that this chart continues to be one of the busiest and most colorful of all my charts. Many things are still going on, all at the same time. Okay, so I've previously spoken some while ago now about two big picture items here seen on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart, with prices currently close to the lower tine. That's below, currently at 129 even. Now, I've said this so many times before, and I'll keep repeating it here yet again. This pitchfork, despite being breached in the past, still continues to show the overall major bullish angle attack of this market. In the more recent activity, and this is where we have seen prices around and on occasion down through all the moving averages, notably the long moving average currently at 130.25, and the medium moving average at currently 139.75. Prices have also been pushed down through the 250% Fibonacci lines at 128.75 and 131.5, as well as the June 2020 high at 134 even, and then moved back up through all of them and up to the 2013 high at 152.75, before ending up where we are now, sitting just above the lower tine, highlighted in dark blue, in a relatively narrow range. The market, despite some sterling efforts, continues to be trapped between the overhead congestion between 152.75 to 155 even, and the congestion below between 128.75 and 134.25. Further up, we have congestion again between 162.75 and 164.75, and between 173.75 to 175 even. Whilst below, well, we don't have that much apart from the October 2023 low at 118.75. Now, the market could maintain itself sitting here between the nearby supports below and the resistances above, though it may have to make a decision soon as the dark blue lower tine of the 2019 to 2021 bullish Andrews pitchfork pushes up over the 128.75 to 134.25 congestion support by the end of April. The question remains as to whether the market has enough ammunition to punch down through the congested support and ultimately break the lower tine and the long-term bullish Andrews pitchfork. I am still not sure on this point. You see, we had lower prices in September and October last year, but eventually they turned higher, leaving an island pattern behind. and the lower time was then down in the 113 even area, not where we are now approaching the 130 area. I'll nevertheless be paying close attention to what happens at and near the lower time. Just remember this, it requires a minimum of 2 consecutive weekly closes below the lower time to even consider it being broken. And given this market, I imagine it might need a few more consecutive closes than that to confirm it. I would only point out one thing. Below the dark blue lower time is another lower time, currently at 117.25. But this time it is from the non-highlighted August 2021 to September 2022 bullish shift pitchfork. That might come into play if the highlighted blue one is properly broken.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.